April 28th, 2015, special board meeting to discuss the audit. Show all members present. Is that right? No, Eugene's not here.
And
We told him about it.
Right.
yeah,
Everybody here?
I didn't know that.
So he's eligible.
I ran into him one day last week. I thought I said something about it.
see this. I'm gonna notice, I'm not sure he got it, but I know.
Right.
Noticed.
Let me tell you, I lost my cell phone Sunday, and so I went back to 3G and no internet and no Wi-Fi, and I really never thought I would be the geek that missed that kind of stuff, but I'm like having
Can we pass it
withdrawals.
out? Can we pass this out?
I'm looking at the side road to give me a Wi-Fi here.
Yeah, put it there, yeah.
Chet, can I have these?
Absolutely.
Use the last.
Thank you.
Sure. Yes, they're all the same.
Oh, yes. Watch.
Well, I'll say y'all are pretty green up here, so that's good and bad. I know the weather's been pretty bad, so it just kind of keeps going around Abilene. I think we're just getting to the dust bowl. So we got a little rain, but not as
Careful what you wish for.
not as much as we need. And my name's Jeff Berry. I'm the audit partner. I think I met some of y'all. I met all of you.
Same year it was.
Maybe
John,
last time.
John, the last year was the other board.
Oh,
Other board, okay, so this will be the first time for Sunday.
Yeah.
Okay, yeah.
Grab my glasses. And I'll just, what I generally do is just go through the report and just the highlights, and if you have questions, stop me, or if I don't answer them here, get it right, and we can get together and get your questions answered. I think this was the first full year, I think, as a district this year. I'm trying to think back. I know last year it was changed, but this was the first full year in the district. So a couple things you'll see throughout the financial. This is the first full year you had interest on the bonds. In the first full year, you really had depreciation on the property and equipment. So that does affect your numbers, but keep in mind as you go through this, depreciation is a non-cash event. So although you did see that increase, it is a non-cash event. And we'll talk about those changes as we get through some of this. Now I can actually see. The first report I'll go through is this one here, and this is the main audit report. It's got the blue halfway on it, and we really got 3 reports, and this is the first one. And if you'll turn to page 1 of that report, that is the audit opinion, and that last paragraph is basically what we consider an unqualified opinion. So basically what it's saying is everything is materially in compliance with GAAP. If you had a qualified opinion, it would say everything except this. So an unqualified is what you consider a clean opinion. It's typically what we'll call that. Now the next section, if you starting on page 3, we won't go through that. 3 through 7 is management's discussion and analysis. Now, when you have a hospital district, it doesn't necessarily fall under governmental auditing standards, but it falls under government auditing standards reporting. So this is part of GASB 34 is what we used to call it. So this is what we call required supplemental information. It's basically a summary of what happened at the district this year. You have some tables in there and just some general information about what happened with the district. And it gives you a contact at the end, I think, probably contact Mr. Reynolds, if you have questions on the management section. So that's really from management is really what that represents. And it's basically highlights of it. Starting on page 8 is really where the financials for the hospital start. And page 8 is your typical balance sheet. I know it's called the statement of net position. Some of that language has changed over the years, but basically, if you had a for-profit company, this would be your balance sheet. And you have your assets really on the left side, your liabilities, and your net position or your equity on the right side. Now, and what I'm going to do is basically go through these assets and tell you really what's changed between years. Your cash and cash equivalents has actually increased a little bit. So your cash position, the $625,000, is basically the same, a little higher than it was last year as far as cash at the hospital, or the district actually had. Accounts receivable is up a little from last year, and the allowance on it is a little less. And what happened too in 14 is you had some bad debts that were written off. Basically a cleanup, I think, in 14. You changed collection agencies. You had some cleanup of some accounts over 180 days old, self-pay accounts, which would have been allowed in the prior year. And really, the allowance calculation is probably the largest estimate at a district, at a hospital. And there's several approaches you can take. And I know, over authority, I think they'll change the way y'all approach your allowance calculation. But there's really two pieces to it. I mean, you have different payers. You said Medicare, Medicaid, self-pay, whatever. And the hospital has a trend of what you generally collect on those receivables. So let's say it's Medicare or Medicaid and you collect 55%. Well, we're going to allow 45% right up front on those receivables. And that's what you call the income statement approach. Now, the balance sheet approach is saying, okay, well, we also have outliers. If those receivables get over 180 days old or higher, then your odds, the probability of you collecting it is probably diminishing as those grow older. So the balance sheet approach comes back to the end then and says, okay, we've looked at the income statement approach, now let's look at those receivables that are out here that are stale, that are getting old, and allow for those as well. So basically, in a nutshell, the end analysis is everything over 180 days, you're just about 100% allowed. So, it's a good approach, it's a good combination approach, it covers your outliers and also gives you a current allowance with the income statement approach. So that's why you're only 64% allowed this year versus 76% last year, because you had all that cleanup this year. Your 180 plus went from over $3 million to approximately $1 million. So with that coming away, you need less allowance because it's basically written off. Inventory, that increased a little bit, about $150,000. I believe that most of that was in OR and pharmacy. And a lot of that resulted, I think it counts at year end as far as adjusting those inventory amounts. And we do actually come out at year end and do an inventory count. We do a sample and test that inventory. Your other current assets is going to be prepaids and just other accounts receivable you have. For instance, the accounts receivable from GN&R, I believe, for your nursing home, as far as the rental on that. I think that's about $60,000, and the prepaids are $140,000. The rest is just various other receivables that you'll have between years. Very comparable to last year. Last year was $400,000, so $10,000. As far as your capital assets, the $19,739,745. Again, this is the first year. Everything's now transferred over to the county, so all the fixed assets are sitting here on the books. And last year that number was $20.8 million, and basically it's the net of it. You did have some purchases this year, a little over $600,000. A lot of that was data processing, $1,000 of equipment, and just some various other things, humidifiers, etc. But the net of that really is what was accumulated as depreciation. So you had depreciation of $1.7 million, you had these purchases of $600,000, $700,000. There you go, your net decrease in the fixed assets of $1 million. You didn't sell anything or dispose of it. I don't think he sold anything this year for studs. So you get to the bottom line, the total assets really are very comparable last year. The total assets are 24,099,48. Last year they were 24,698,180. So on the asset side, it's pretty comparable as far as some shift up top, but overall it's pretty comparable. Your liabilities on page 9, and really those top two lines is the current portion of the notes and the current portion of the bonds. And then if you combine that with that middle section, those long-term liabilities, that gives you your total debt of the district. And really what happened with that total debt is it decreased about $500,000 this year, just net payments on the bonds and notes this year. And then the others, accounts payable, accrued expenses of did increase this year. A lot of that was some payroll taxes that you had outstanding at year end. And some penalties related to that. That also affected the claim. Then your net position, is two different categories, okay? You break out, and that's really your equity. We'll say it a different way, it's your equity. That's two pieces, invested in capital assets, and then your unrestricted. You see, your unrestricted is actually negative, but really it's combined for your total equity. But invested in capital assets basically says, okay, let's take your total capital assets less the debt related to those capital assets, and that's your net equity position on those capital assets. So your total equity is a little over $6 million at 9/30/14. Now page 10 is your income statement. And overall, there's some large changes here that happened that really tell most of the story. One, your bad debt increased $1.8 million. Okay, we talked about some of that cleanup, but there was another factor I think that really affected it as well. With the rules on charity and everything you had to complete to get that charity, get somebody qualified for charity. That didn't happen, I think, in all cases. That actually decreased $800,000 last year. So a lot of that probably went right up there into bad debt, because if you can't get them qualified for charity, most likely it's going to end up in bad debt. So your charity went down to $800,000, so that's going to be part of that $1.8 million. And then the other $1 million or $1.2 million, whatever it was basically cleaned up. And those 180 plus. Now and that gives you your net patient service revenue is $14.3 million. Last year was $15 million, right at $15 million. So fairly close. You look at the cleanup, that's a lot of the difference, I think, in 14. The next sections are the electronic health records. That's an incentive to basically get everything modified for the electronic record world we're fixing to all enjoy and be in, continue to be in. And then the next section is your UPL, and really that deals with your state Medicaid, really your difference between your state and federal is what that's funding. Now last year, your EHR was a little over $1 million, so that decreased about $365,000. Now UPL payments decreased about $783,000 from last year. Now a lot of that's politically driven on UPL right now because they're holding it, and when that will get paid is everybody's guess. And there's some large facilities too that they're in the same boat. A lot of those are being held. I don't see them being able to do it forever, but that's just my opinion. But hopefully it'll all get back to some kind of normality for everybody. So that was a large change. And we talked about the interest expense also increasing. That increased about $500,000 for the year. Okay, so that you didn't have that last year on those bonds. And depreciation expense increased about $700,000. So between those two, that's $1.2 million. And then you add in the bad debt cleanup plus the loss of the charity, that's another $1.8 million. So that's a lot of the difference between the years. So your total operating revenue is another support. You see it's at $60 million. That next section is your operating expenses. And a lot of these categories, now this is consolidated too, so it's going to include 501A plus the hospital. Any due to and due froms between will be eliminated. Any rent between will be eliminated. So this is basically a consolidated look. And the reason we do that, the hospital doesn't own it per se, but they're economically dependent on the hospital, really, to continue on, and that's why we consolidate it. Your operating expenses, so that includes your 501, I know you got a new position in 14-2, so that's gonna affect those salaries, employee benefits up top. And plus just the cost of RNs and LVNs, just nationwide, it's continued to increase. That's all your medical workers has increased. Supplies went up this year as well a little bit, and that's because now you have indigent care, which once it became a district, the county is no longer responsible for that piece of it. You had, I think, 300,000 to 400,000, Ray, probably at least, that applied to the indigent care that you had to cover at the hospital level. And the rest of the expenses are really comparable once you take out the county expenses we had last year. We actually went in and booked an entry for the rent from the county, which was about $860,000, which is a revenue and an expense item, which you won't have now. What you have is depreciation. You don't have the rent expense, but you have all the depreciation now, which is $1,759,026 this year.
And so how do we come up with that depreciation number?
That basically is taking all your buildings and everything else that you now own, and we're looking at the rest of the useful life of that, and it's a straight line basis. So let's say the building still has 30 years of life, we're taking 30 years and just dividing that cost out.
Do we have a schedule of depreciable assets along with accumulated depreciation anywhere?
Yes,
So
well,
what, in any of this?
The schedule's not in here.
it's not in there, no, sir.
No, it's not. Everything is on a straight line basis, right?
It is, yes, it's all on a straight line basis. That's correct. So you're looking at your operating loss, really it's at $4 million, but if you compare it, if you took apples to last year would be close to $2 million. If everything was the same as far as where it was slotted, your revenues and everything else, because your tax revenues for a district, you see your district tax revenue at the bottom, that's nearly $3 million, so that's down below, as well as your interest expense too. But your net deficit of revenues over expenses was $1,657,000. Okay, last year it was a positive $647,000. Now keep in mind too, we just lost $1 million through, they reduced EHR plus the UPL were reduced to $1 million between 14 and 13. So that makes up a lot of that difference right there. And then your cleanup on your bad debt is the other primary. Really, your stats were pretty comparable. I think your case mix index actually improved a little bit. You had more surgeries, which the case mix, and anytime you say the case mix, what you're looking at is your DRG mix. And the higher the case mix, generally the more profitable that procedure is. So as you build that case mix up and look at those procedures that are more profitable for you, that's when you look at a lot of your pricing and what can affect the hospital. As that case mix goes up, you can still have your patient days down and sometimes make more money. So a lot of it depends on your DRGs. You can't always pick those, but a lot of times they'll match your physicians that you have, and that's why you have your physicians hired a lot of times to bring some of that to the hospital. Okay. And then 11 and 12 are a cash flow statement. And really what that's going to tell you, and really the goal of any entity or business, that top section is going to be cash provided or used in operating activities. And that's what you really want to work towards, getting a positive number, or close to positive. You look right below that, the non-operating income of $3 million is going to be primarily your tax revenues. So district's a little different. You can kind of look at those two kind of combined and see, well, really operation after we had the tax revenues and where were we at. So then that next section for the capital and related financing, that's where really the excess was spent. So it's going to be spent on capital assets and repayment of debt, and also the interest payments. So $1.9 million went out for interest. your principal and also your capital purchases for the year. Your total cash, like we talked about earlier, actually increased $64,000, and that's kind of how it all increased and how it flowed through. And then starting on page 13 are your notes. I know y'all all love to go through each one of these, but I'll give y'all a break. If y'all have questions on these, none of them have changed in the last few years. I mean, this is good information, really. If you, for instance, if you turn to page 19 of the notes, actually page 18 of the notes, page 18 of the notes and 19, I think, and 20, that gives you an idea of what happened with the debt as far as where it started, what was added, what was paid, and then it also gives you a maturity schedule. And I think on page 20, it gives you a maturity schedule of the bonds for principal and interest for each year until they mature. So that gives you a good idea of what will be coming up as far as payments.
Yeah, just a kind of quick explanation, and this came up earlier, since we're a government entity, that we don't use governmental accounting, we use enterprise accounting. Why don't you just kind of explain that just a little bit in terms of why that's the way it is? Yeah.
Well, in a district a district is treated more like an enterprise fund. An enterprise fund in governmental is like your waterworks, your water district. And basically what you're saying is most of those revenues pay for the service. So when you have a hospital district, your patients are coming in to pay for the service, and that's why it's considered an enterprise fund. So and when you have an enterprise fund in a governmental, you're booking all the accruals. So it's on an accrual basis. Whereas a fund statement, if you were a typical fund statement, you wouldn't typically book all the accruals. So this is going to be more like a regular business, is what I would say, is what I'd liken it to. And that's because, again, the patients pay for those services, which creates that enterprise fund.
Questions on
And it is a district too. But, I believe, and then when we had on page 24, we had discontinued operations. That was last year, 13. That was the nursing home. Basically, we had a little bit flow through this year, not, I think maybe less than $10,000. Something else to transfer between. But all that was really considered discontinued operations in 13 because of the true operations of the nursing home ceased then. You still get rent on it, but the operations of that facility ceased what they were doing. As far as the nursing home. You get rent, and you're also paid, I think, for the PT. And some other.
Yeah, we actually ceased doing that during this year, so
Just
next
straight
year
rent.
we won't be in the PT will be.
And then on page, starting on 26, that's your consolidating schedules, and what that's going to do is take the hospital, the nursing home, the 501A, and looks at your eliminations and puts it all together, and that's the numbers that really go up front. And typically typically most of your profits are on the hospital side. I mean, 501A will not typically show profit, but the hospital will benefit from that relationship. So most of your profits will end up in the hospital, typically. That's all I have on that one, unless y'all have, I got 2 little reports to go through, if y'all are okay with that. Ray, anything else I need to
No.
cover? Okay.
Anything else from y'all? Okay.
Then I've got, the next report is what we call our report to the board, really, is a report to y'all. Board and Finance Committee, that's, and what this talks about, if you look on page, let's see where it starts, starts on page 3. And it just gives you an idea of for instance, if we had significant or unusual transactions that there was no guidance for, we would probably tell y'all, or we would have to disclose that to you. Or if you had any disagreements with management, we would disclose that to you. And what it does is tells you as a board that if we have disagreements between us and management, then there's generally a reason that there may be more sensitive data. And we did not have any. And then also we disclose our audit adjustments and also what we call uncorrected misstatements. We had a few little. An uncorrected misstatement is generally an audit adjustment that's immaterial. Let's say it's $2,000. We don't make the adjustment, we report it to y'all. So you'll know that we have that in our financials. And if you turn to page 6, that's the audit adjustment. We've got it for the hospital, the 501A, and the patient as well. But the first item was really just a reclass of 426. And then you can see the inventory adjustment, a couple more down, the 126, 417. The really largest adjustment was depreciation. The depreciation adjustment was $900,000. That and accrued penalty were the two largest items. Actually, your Medicare and Medicaid settlement actually declined 273, which is positive. Really, these two numbers on the right, that's the net amount that we adjusted. So if you took those, combine those two, which is about 600,000, something like that, I think. And then on page 7 is the nursing home. Like I say, we had a few that we reclassed mainly. The net effect to the income statement was $469, which was an income, just to clean it up. And then the 501A, really the largest adjustment here again is really was the penalty. The clearing account and meaningful use reimbursement is actually something we just cleared out. Some of those dollars actually were already accounted for. So really the typical adjustments, we typically will make those same, I think we typically do depreciation. We've had some larger allowance adjustments, I would say in the past, and I think the methodology, I think once that was changed, it's really, I don't think we've seen that the last few years. So and that can be where your large adjustments occur in that allowance. So that's what you want to try to keep on even keel, make sure that's adjusted currently, so you'll know what's going on each month instead of having that surprise at the end of the year for $10 million or something. But that's very important for healthcare. On page 8, that's the uncorrected misstatements. So we basically had one adjustment in the for the 501A to pass on the PTO accrual. For instance, we knew you probably had more accrual there, but you're probably going to catch it the next year, so we just showed it as a past adjustment. And it was $9,000. Then page 9 is just some recent, some of the recent things going on in the industry. Really the largest thing going on with everybody right now is well, there's two things going on. Really the revenue project. The revenue project will probably affect everybody. And how it's going to affect healthcare, we don't know yet. There's been lots of discussion of whether or not that will affect, for instance, self-pay patients. And there was some discussion at one time that those will no longer be accrued, that you won't show it as revenue until you collect it, which would be way on the back end. So you never would know. In other words, if somebody came in with a self-pay patient, you wouldn't show any of that revenue until they paid it. But I think they backed off that stance, is kind of what I've understood lately. And they also pushed this standard out another year. So probably 19 or 20 before they get anything together. But it's lots of accountants, I guess, talking. And then the other big change is GASB. And it won't affect y'all over 401K or 403B. So y'all are okay, but for pension plan, it's going to be a big change. And for pension plans, those liabilities will be required to be booked. I believe it's city that doesn't currently show that, or county, they don't show those liabilities on their books. They disclose it, but they don't show it. So those will now be required to be booked in some instances, depending on the plan, which may not affect you directly, but it'll affect lots of people around, I think, as far as what people are seeing. And I think the ICD-10 got pushed out another, you heard that? Right.
No, we're still in
Still at October
October,
first.
October,
Yeah.
we're still in that, yeah.
Would that change likely be going towards the entities who depended on their upcoming revenue to fund their retirements? Okay.
Yes.
So we certainly don't do that, do we? We don't even have to
No.
have retirement?
Sorry, yeah, 401K, 403B.
These are mainly, pension plans. Yeah.
I don't know why they allowed municipalities to do that to start with.
That would probably, in all likelihood, kill the pension plans in total. And then our last report is, we did have some comments, and we go through control, not just go through them briefly, it's the one that's stapled. We basically look at the control every year and look at how things are, and when you have changes in personnel, we try to look at, well, your control still in place to cover that. And I think in general, on your cash, we just wanna make sure, whoever's responsible for reconciling that cash doesn't also have access to the signature stamp, and that was our point there, so we need to separate those duties. You don't want anybody controlling all those people, and I know you'll have some other
Control, yeah.
controls put in place to compensate for that. But, and it's not so much we don't trust you, it's you don't want to put your employees in those positions either. So it kind of helps everybody all around. Same with purchasing, and this is new vendors, and just make sure that process when you're getting new vendors is sound. I mean, you can imagine how many invoices, how many invoices go through the hospital, sometimes weekly. So a lot of, that's what I'd say a high risk area for potential fraud are those vendors. So if somebody has control over cash, signature, the signature stamp, and a vendor, you got the whole process. And you set up a vendor, you can write your own check, approve it, and then you've got something that's gone through that you didn't approve or shouldn't have gone through. So all those, just make sure all those elements are covered, and you can do compensating control, anybody else look at part of that process along the way. So if you have another control. The inventory, basically just make sure your accounts are including everything and this was OR basically. Because I think we added about 65,000 to the inventory count, which pretty really positive, but you want to catch those as you're going instead of and then revenues, we had a couple cutoff issues as far as revenues that were in 15, should have been 14, it wasn't material, so, but again, you just want to make sure you're getting all that cut off is clean. That's a big deal for a hospital to know. And sometimes you have manual things it's hard to catch everything sometimes, but just maybe especially at year end, you want to make sure that's solid, so you have, when you compare your years, you're in good shape. And then also accrued expenses as far as the payroll liabilities. I know y'all are working on getting those paid off, and you're current on your stuff now. And really your financial statements through 2/28 are pretty positive, and when much more positive than right where we're at now with these financials. And also we have an adjustment that we accrued some of these penalties, which will affect you positively, $182,000 through 2/28/15. So when you add that to the consolidated, you're about break even for the year, which is good. I think that's the last one on comments. Healthcare is a complex world. Yeah.
Questions of Jeff, anything?
So about how much do we still owe him back penalties on?
We're current on, we're making our current payments now,
Yes,
so,
and have we paid off all of the
we
interest?
still have some for the fourth quarter. So we get those paid, and then we're staying current now.
Okay. Do we still owe some from before current now?
Yes.
And that's about how
I
much?
don't know what that is.
I don't know off the top of my head.
Yeah.
so.
It's about 4 payrolls.
Mhm.
Payrolls,
Payrolls,
$70,000,
okay.
yeah. About 4 And just brief explanation on that, you know, hey, end of the year, you run out of cash. And you're faced with the decision of either paying Fisher or paying, you know, PSS or you delay your payroll tax. And once you've incurred the penalty, I mean, it's all over with, interest is nothing. It's the penalty that gets you.
I'd have to think that if we're getting close to something like that, it would be a problem to share that with the board.
I think you're right, I think you're right. We've looked at it, we could have done a better job of that, we actually did that.
So I assume we're gonna put together a list of ways to fix these things, right?
Yeah, you know, on the, just quickly, I'll tell you where we think we are on the cash. On the cash, Michael or I, now only Becky, sign every check. You know, we do the Becky, when she was the controller, had access to the signature stamp, and she also did the bank reconciliations. But for any check to be released, it required a signature from, or an initial from either me or Michael. So any check that went out, and then the auditors come in and they verify that the checks that are released have somebody's initial. So we think from a control standpoint that we've met the requirement on that in terms of somebody's check clerk. And now with, go ahead, yeah.
In addition to that, at the end of each month, we review the bank statements, are reviewed as a whole for anything that looks.
All the bank statements that we got.
Yeah, Becky prepares them, and then either, it was Michael, but it's now me, will sign off on all the bank reconciliations at the end of each month. I did that today.
Do we find mistakes that the banks made?
We wish.
Not many.
We like find more mistakes where we forgot to write something down?
No, we reconcile,
Well, I mean, when you reconcile.
Well, that's why you reconcile, to find any difference between your books and the bank balance, but we reconcile to the penny every month.
So does the employee that's responsible for reconciling the cash accounts still have access to the signature stamp?
Yes, Becky does. Becky has access, and what that is, our checks come out, it's not a signature stamp.
But they're saying we should separate that out to two different people.
It's hard to do in a small organization. We got one CFO. Now, we have our accounts payable clerk who processes the items for payment. But in terms of who has control over the plate, yeah, the CFO has control over the plate. And that's why we try to say our backup on that is that we don't release a check without being initialed by someone other than the person that has access to the plate and does reconciliations. And then that is an item that's audited whenever they come in. Make sure the checks have that. And then on the purchasing, I guess we think we have that covered in that the new vendor is recognized either by our purchasing manager or by a department manager. So they identify a new vendor. That vendor comes up to the accounts payable clerk. The accounts payable clerk then enters that into the system and requests a W-9 from the vendor. So we think that we've got that covered by having the vendor introduced by the department manager, having it put in the system by the accounts payable clerk, then get a W-9, and then any check then that's issued to that vendor then goes through the process of requiring an autograph before it goes out. So we feel like we have other controls that compensate for that. I guess the inventory, we thought we had that cured this year in terms of OR, but we thought we had that, I guess that solved in terms of getting an accurate inventory. That's a tough area to inventory with all the packs and all of that, but there was, there's still variance, so.
Yes,
we have to work on it.
Dollars,
The revenue cutoff, I mean, that's at the end of 2014, we generally leave the end of the year open for 6 days. That gives time for all late charges to come in, So if the end of the month's on 30, we close the books on the 6th. You know, and that's pretty much what we try to do on that. And we talked about the liability, federal liability, we agree with you on that. Anything else?
No discussion? Somebody wanna make a motion and we'll do something?
From my perspective, we'd like to have the board approve the audit.
I move we approve the audit.
All right, we have a motion, is there a second? We have a motion and a second, is there any discussion? All in favor, raise your right hand. Show that it's unanimous. Last time on business, somebody make a motion to adjourn.
Aren't you making vote?
Come on, I'll make a motion to adjourn, let's go.
Okay, somebody second.
I'll second it.
All in favor, raise your right hand. Approved.
Thank y'all very much for your time.